Hello, today's topic is investment options before us as retail investors in India. The background of this video is my observation around about the people around me who I think have some general idea about the investment or asset classes available, but which to use when for what purpose they don't have much idea, and that's why I prepared this video so that I can make them aware that these are the asset classes or options available before us, and which particular asset class to go for at which particular point of time, which purpose. My aim is to make you aware of that. So let's go forward. Now here the first question arises is why invest? Why to invest? Why to depart the satisfaction which you can derive today from consuming the money you have or you saved and leave it for future. So the first one is inflation. You might have heard of it, but in nutshell, I want to explain that inflation is just the value of money going down. So for example, if all of your needs, your expenses are taken care by 100 rupees today, you would have observed that next year or after some time 100 rupees won't be sufficient. So maybe for simplicity's sake, next year you will need 110 rupees to satisfy your expenses, maybe food, travel, rent, electricity, etc. So if you still want to spend 100 rupees only, I think close to 90% of your full needs of today will be fulfilled by tomorrow in 100 rupees. So value of those 100 rupees is going down. Today they fulfill all of your needs, tomorrow it will be 0.9 or 90% of your needs. So that is inflation. Second I have listed down is age. As regular working class, all of us have retired age of 60, and after that we stop working. We are based either on pension or our investment savings and the returns generated by them. So that is one, we have to prepare for that age when we are not working. Third is independence or optionality. This is a kind of philosophical, but I think very, very relevant in today's age. Money or savings or investments give you optionality or independence, where if you don't like to do work for a particular company, or you don't like your boss, you don't like your colleagues, you think that your skills or values are not respected by the people around you in your office, you can take a break. Just like that, you want to try something of your own, like I am trying, you can take a break if you have savings. So you will be assured that you'll not be hand to mouth, or you'll have to look for other options or beg to people, etc. Money, savings or investments give you that optionality, that independence. Fourth, related to it, third point, it gives you financial security. Suppose you are very happy with your job, very happy with your employer, you get along very well with your colleagues, but still some emergency arises, maybe some accident, maybe somebody got a loan, some tragedy occurs in your family, and you need money. If you have investments, if you have savings, that gives you security that you will tide over the adversity very well. So those are the four primary reasons I think you should invest. Now, investment options before us, I have listed down. First one is savings account or FD or RD, which you can get from any of the banks. Second is real estate, everybody knows about it. Third is government schemes, public provident fund, national savings certificates, NPS, etc. Other than that, we have insurance or ULIPs, stocks or shares you might have heard of. I'm sure you'll have heard of bonds, mutual funds, and portfolio management services. So I'll be talking going forward about the pros and cons of each and every investment options, and via that I want to inform you that which investment option to go for based on what your need is. I think where gold is applicable, mutual fund might not be applicable. Where bond is applicable, portfolio management services might not be applicable, and so on and so forth. So let's take them one by one. Now, savings account or FD or whatever it has to do with your bank. And anyone can open a savings bank account. If you're a salaried person, automatically you get a salary account in which your salary goes at the end of the month or beginning of the month, and it earns some interest. The pros or positives of that account as investment is they're the easiest. You don't have to do anything, really. You don't have to do anything. It's automatic. Money goes into it, it starts earning some interest, and the returns are guaranteed. The second point, you know that you'll be earning either 3.5 or 4% or 3.75% year on year. on the money left in your account. You don't have to do, really don't have to do anything. The cons or the negatives or the downside is returns are tiny. I mean, think about it, 3.5% or 4%. These returns are tiny, and on that, more than 10,000 rupees as interest per year, government will ask you tax. If you fall in the 30% tax bracket, if you are earning 3%, your real post-tax returns are only 2.1%. And of course, inflation is far higher, far higher. I mean, you might have read the newspapers, heard on media that inflation is going up and up to 9.1% or 10%, etc. And compared to that, your savings bank or savings account returns are tiny. So in long term, if you keep your money in savings accounts, you lose out on inflation. That's the primary purpose of this slide. Now, real estate, yes, the positives are it's very popular. Everybody knows about it. You might have heard that somebody has bought land, somebody has got built house, villa, or land, etc., etc. It's very popular. Everybody knows about it, and there's a belief system attached to it. When I was starting my job in 2 3 years, whosoever my colleagues or my friends or relatives had bought either flat or land, my relatives used to say that no, that guy has arrived. I mean, that guy is settled now. He's bought a flat or bought a house. Now he doesn't have to do anything. That's it. So that's a belief system we have in India. And third is it's a real asset. Yes, if you bought a flat, you can touch the walls, you can touch the interiors, and derive satisfaction that you have done something tangible. So that's the security it gives you. Now the downside is investment quantum is high. I mean, right now the prices have gone very sky high. I mean, in Bangalore or even in the tier two cities, you'll not get any simple 1 BHK less than I think 40 45 lakhs at least. So that investment quantum you have to put up to buy real estate is very high. Rental yield, I mean, if you're buying real estate or flat, thinking that you'll be able to derive rents out of it, rental yield in India, there's a given data that it's not more than 3.1% or so. So again, it's comparable to savings account returns. They're tiny, and land titles are not clear. You might be hearing from or reading in newspapers that no, land title was not clear. Somebody else put up a case that no, land is mine, and then a case is going on in courts and people are contesting, etc., etc. And there's a lot of uncertainty. You don't know which option to go for. I mean, in the same area there are two flats, two apartments. Which one to go for? One is say 2 BHK, one is 3 BHK, or maybe from different builders, or maybe just because of some. So one is on the main road, one is in some interiors. Which one to go for? That skill not all of us have. I have known people, some colleagues, some batchmates who had bought flats in 2013 and they sold in 2023, 10 years later, at the same price which they had bought in 2013. Only thing they earned was a rental, and that was not sufficient to cover their interest amount of the loan they had taken to buy that property. So a lot of uncertainty is there, and not everyone has a skill to evaluate which property to go for. Gold is one of the options. Again, it is very popular. Everybody has jewelry, or I have a relative who keeps on buying gold biscuits, silver biscuits, and keeps them in bank locker. Again, there's a belief system that no, gold prices won't go down, or if they go down, they'll come up, etc., etc. And again, it's a real asset, just like real estate. You can touch it, feel it, admire it, and keep it in locker in the safe custody of bank. The downside is there is a carrying cost. If you are keeping it at home, you have to make sure it is safe and secure. If you keep it in bank, you have to pay the locker charges every year. Second thing is there is no benchmark. How do you compare gold prices or gold returns? I mean, you can't compare it with savings account or maybe real estate because they're different, and nobody knows, or there's not written anywhere that gold will give you so much percent of interest or return. No, nothing. Transaction cost is there. If you're buying from established players like Tanishq, what the thumb rule they say is if you are selling them back the jewelry which you bought from them, they'll I think bought at the current price. But in case you are selling jewelry from one jeweler to other, they'll put us some cost, so, and which is very high. So that is transactional cost is very high. A lot of risk is there. But no, whether you bought some jewelry, whether it can be stolen, like I said, carrying cost is there, or maybe when you are using it to wear in some celebrations, etc., it can get stolen. So a lot of risk is there for with gold as investment option. Now there are some government schemes very popular in rural areas as well as in urban areas. Belief system is there, government won't default, it will take care of you till your death, etc. Very easy, you just have to go to some post office or some government bank, and they'll give you tons of schemes that you invest in this, you'll get this much percentage of return, and the returns are guaranteed. They're backed by guarantee of government of India. So you must be pretty sure that government will uphold whatever it is promising. Now the downside is returns are less. If you compare with the savings account, yes, returns are more, but they are lesser than what are some of the other investment avenues or asset classes which are available right now in India. And there's an upper limit for that. For example, if you see PPF, I think upper limit is 7.5% or so. You can't earn more than that. Because they are backed by government decides. And then third point is regulations. It will be, say, there will be upper limit first, and then regulation says that not more than this you can invest, or some returns will be driven by this. And ultimately the 3 points consolidate to the fourth, and in a nutshell it is government control. Today government is giving you 7.5%, 8.5%. Tomorrow if government thinks that it needs more money and it shouldn't pay you much, they can reduce the interest rate anytime, 6.5%, 5.5%, and you can't do anything. It's backed by government, controlled by government. You have to live with that. Now again, there is another asset class called insurance, or ULIP, unit linked insurance plan. Pros, very popular. You or your relatives must be knowing some LIC agent or the other. So it's very popular, and it gives you a sense of security. Insurance generally means that dictionary meaning is whatever you're doing is backed by or will be taken care. It gives you a sense of security. Again, it's a belief system that if you have insurance, in case something bad happens, the insurance company will take care of it, and the returns are guaranteed. They'll give you in writing that I'll give you this much percentage of return in case of this plan. So they are written. Now the cons is returns are less. Yes, I bought an insurance policy via my father. I didn't have any knowledge when I started my job. My father enrolled me in some LIC policy. I calculated recently its return. It's giving me 4.66% return. I started investing in 2002. I'll get my money first lump sum money in 2028. So around 26 years, and I'm getting 4.66%. Though I saved some tax, yes, but returns are very, very tiny given my money got locked in for 26 years. And then there's some confusion, a lot of confusion regarding whether if you're going for insurance, it is insurance, that means insuring you against some adversity, or it's an investment which is supposed to generate a return as much return as possible given your risk profile. So if you go for, say, some insurance ULIP, part of money your money as premium gets invested in the investments, and part of your money is takes care of the premium which will give you money in case something bad happens. So but that returns, if you you calculate and analyze in detail, you'll get confused that which which two objectives are satisfying, whether it is insurance or investment or both or nothing. So that confusion is there if you go to the fine details of whatever the prospectus you're given by the LIC agent or insurance agent. Now, stocks or shares right now, markets are all at all-time high, and you would be reading or hearing on TV that a lot of people are making huge amount of money by investing in stocks. You would be hearing a lot of big investors saying that invest in this stock, or I bought it at 18 rupees, right now it's at 1800, it's a 100 bagger, 50 bagger for me. So everybody, I think, knows about stocks and shares. So pros are very popular nowadays, and you have sense of control or knowledge or both, that you're reading a moneycontrol.com. There are many websites, many Telegram channels, WhatsApp channels which give you tips that now buy Cipla, it will go up by 10%, buy Reliance, it will go up by 15%, etc., etc. So you think you have sense of control, and you can manage your investment, and nothing will happen to them. And it's very easy. Anyone can go and download an app, say Grow or some other app, Zerodha, and start trading. And a lot of material exists. You can read as much as possible. YouTube is there, various blogs are there, various channels are there, and then which they claim that they have analyzed all the companies in detail and coming up with some real investment advice. The cons is they are very volatile. Whenever I talk to investors, I tell them that to keep in mind that your investments can go down by 25% anytime. It generally doesn't happen, but be prepared for it. If you can't see your stocks going down by say 40% or 50%, don't invest in stocks. That's the advice given by none other than Warren Buffett. So they are very volatile. Now, cons is you'll have to analyze the companies one by one. You'll have to go to their website, go through their financial statements, means balance sheet, profit and loss statements, cash flow statements, go through their annual reports, investor presentations, con calls that know what are they doing, what are their plans, where they are investing, what is their management doing, buying or selling, are they going into some new area, setting up new plants, or demerging a particular business, selling off that business, etc., etc. That you have to take care of. The effort you have to put in. Now, stock market high return 90% is driven by emotions. I think it should be 98 or 99% driven by emotions. You would see a company doing nothing selling at astronomical valuations, while a company which is doing good and financials are clean, promoters are ethical, still not getting so much of value time to time. So it's driven by emotions most of the time. And the fourth point, and I keep on telling people that don't believe me, that most investors or traders lose money. I'm not saying it's the statement of Mr. Nitin Kamath, who runs Zerodha, that most of the traders lose money, and this is the data he has gathered from his app only. People lose money, so it's risky. Now there are bonds, you might have heard of. Bonds are the debt raised by company, and if you give some money to company to invest or set up some plant, they are raising via bonds. You are supposed to get some interest, which they'll pay to you. So positive points are there are many options. Bonds, in fact, one company can issue one type of shares in India most of the time, but they can issue say a lot of more than one kind of bonds. So there are many options. It's very easy to invest. You can go to any, just like stocks, you can go to any brokerage app and then buy or sell. Redemption value is known because that is also known as par value. You buy a 100 rupee bond and you can sell it at say 100 rupees only when it is on maturity. And a lot of material exists. I mean, you can read about the companies, read about the issues, what they are going to do with the bond, etc., etc. That lot of material exists. The cons is returns are less. If the company is doing great, they won't offer you much interest because they know that you will be investing. Apart from that, as I said, in stocks you have to analyze companies, financial statements. But in case of bonds, extra effort is you'll have to analyze issues. This particular issue of bond is backed by what asset? It might happen that company has issued 3 kinds of bonds, and every bond is issued by a particular, say, plant or machinery, etc. So you will have to analyze the company, how it is doing, and this bond is backed by which asset of the company. And kind of illiquid, because if you see the market, though it is bigger, bond market is bigger than stock market, but the ticket size is very high. So kind of illiquid market is there, and you think that you can sell your bond as soon as possible or whenever you want, just like stocks. No, it's not that. Now, mutual funds, there are vehicles in which a lot of investors pool money. That money goes to a mutual fund manager or asset management company, and they, based on what they have said in their offer document, invest your money in some companies or across companies and some other instruments, and they'll give you monthly portfolio disclosure that we have. This is how our portfolio looks like currently, and they'll charge you some money in terms of commissions, percentage of money they are managing as their fees. Now, pros is there are many options. You go through any AMC, lots and lots of options are there. The multi-cap fund, flexi-cap fund, thematic fund, and sorry, equity savings fund. This funds based on balance fund, funds based only on debt. Foreign some mutual funds invest in foreign companies as well. So there are many options. They're very easy to invest. Again, you can download any brokerage app and you can do investments in mutual funds. You're getting expertise at very low cost because somebody else who has got the skills and knowledge is managing your money. Of course, they are charging, but you are getting that expertise in very tiny fees, I would say. And the transparency is there. As I said, monthly they have to disclose the portfolio that no, we have invested in this. You can have a look at the portfolio and think that no, this goes against the purpose of why you invested in a particular scheme of a mutual fund. You can very well redeem the units. Liquidity is there. You put up a redemption order today, tomorrow, or day after, you'll have the money based on the NAVs and the public holidays, etc. They are very liquid. Tax benefit is there, especially in equity mutual funds. You get tax very less. The long-term capital gains tax right now is 12.5%. So compared to other, say, savings account interest, etc., a lot of tax benefit is there in equity mutual funds. And regulatory comfort is there because regulators, they are SEBI, which forces that no, you have to follow these guidelines, or you are saying in a particular scheme that I'll invest across market cap, you'll have to do it. If you have to invest, you say that I'll invest in small cap only, you have to invest in small cap only. That kind of regulatory comfort is there, but the downside is lack of optimization. That you think that at this particular point of time I should be in, say, 75% in, say, petroleum and 25% in FMCG. You'll have to either invest in those kind of schemes by yourself, but if you have invested in, say, flexi cap or multi cap or small cap and some other schemes, you'll not get that optimization as per your need. That's the downside first. Second thing, which is linked with the first pros, choice overload is there. You'll be overwhelmed by seeing or going through the number of choices AMCs have come up, and you'll have very hard time deciding which scheme to go for. And that's why you need either a advisor or mutual fund distributor to help you guide and choosing the schemes based on your needs. And you'll have no control over the cost. It's decided by SEBI, and generally it's 1.5% or 2%, but you won't have any control. You can't say that no, I'll give you 0.5% or 0.25%. It's same for every investor of mutual fund. And again, last one, there's no guaranteed returns. I was discussing with my school friends, and one of the friends said that in case I, as mutual fund distributor, suggest some mutual funds to somebody, why should he pay me? So I said that no, I'll, given my knowledge, given my outlook of the market, I will suggest the best mutual funds for that point of time. But I can't guarantee returns, and I suggest the same to you. In case some mutual fund agent is guaranteeing you some returns that you'll earn, say, 12%, 15%, 18% over the next 4 or 5 years, I suggest don't believe him and just walk out. Somebody say that it depends on market, that's the guy you should go for, because mutual fund returns are subject to market risk. You would have seen that disclaimer in mutual fund sahi hai advertisement. So that's the way to go for mutual funds. Now here, the last one, portfolio management services. These are very similar to mutual fund, but here investors pool money, and they the portfolio management services manager trade on their behalf and allocate the investments. So they are customized portfolio based on investor need, because they'll open you a brokerage account, and through that they will do the trading. They will have full control. So portfolio will be driven by your needs and risk and return profile you need. And of course you will be getting expertise of portfolio management services manager, just like in mutual fund. There's a transparency. Time to time they disclose in their presentation, they come up that no, we have invested in these sectors. At least some PMS I've seen, they disclose the top 10 holdings or top 25 holdings as well. They say that we will not invest more than in 15-20 companies. That's also there. And there's a liquidity here again. You want to redeem? Yes, you can redeem. Though some PMS and mutual fund put up some exit load in case you invest or redeem your unit within 1 year. But I suggest, as I suggest my investors, that in case you're going for mutual fund PMS, or even stocks, uh, have an outlook of 5 years at least. Have an outlook. In case it happens, your target price is reached, your objective is realized before 5 years, it's very good. You're lucky. But have at least a horizon of 5 years, 5+ years, I would say. Now, downside is minimum investment is 50 lakhs. That's there. There's a asset class coming up which has been proposed by SEBI. I think the ticket size would be 10 lakhs, but it is yet to come into existence. But in PMS, the ticket size is 50 lakhs. You won't have any control over the cost. It will be driven by the agreement signed between you and PMS company, and there will be some brokerage charges you'll have to bear. Third point is there's no guaranteed returns because it's driven by stock market and the decisions taken by the fund manager. If anyone promises you that this PMS will give you 12%, 18%, 25% return, don't go for it. Don't fall for it. And again, choice overload is there. If you analyze the number of PMS companies which have come up in India, everybody claims they're good, and everybody has got their marketing material ready, and huge number of PMS exist. Again, you'll if you don't know, I suggest you go for a distributor or investment advisor to help you identify the good schemes, or at least the appropriate schemes given your risk return profile and the objectives you have. This is, I think, last slide, and these are some tips from my side, because if you invest in markets, say stocks, mutual funds, or PMS, first one is don't think in terms of say months or quarters or weeks. I've seen people doing daily trading. My suggestion is don't think in these terms. Think in at least 5 years, or if not, and if possible, in decades. Let your investments grow. Let the fund manager's theme or hypothesis play out. It takes time. I mean, I'm friends. I know a PMS which takes position based on the ignored sectors. They themselves told me that sectors recognition doesn't happen in 1 year or 2 years, 3 years. Things take time. Fund manager takes position based on that. No, this will happen. These companies will get recognized. Re-rating will happen. Some regulatory changes will happen. Markets will open up. They'll be able to export. They'll be able to diversify, etc. These things take time. So that's why I suggest, if possible, think in decades at least. Now, second point is, I've seen people complain that my stock is not going up, whole market is up, but my stocks are down by 20%, or market is moving up, my stocks are at the same level, market has gone up by 20%, my portfolio has gone either down or maybe grown by 2% or so. Say, if they do not grow, do not go up for some time, don't get frustrated, don't yell on your stocks, because as I said, it's not necessary that market goes up and your stocks go up. No, it happens all the time. Your stocks will go up when market or people recognize they are undervalued. Only then they'll grow. So don't worry about the markets. Worry about your process. If you have bought undervalued stocks, they will grow. Don't worry. And third point is, if something is free, you are the product. I have done a lot of product management in my career along with investments, and there's a famous proverb that in case something is free, you are the product. That means you are through you they are earning money. If you're getting some tips, some Telegram channel, WhatsApp channel, or maybe some SMS, etc., that no, invest in this, it will be a multi-bagger. You're hearing on YouTube, you are getting some videos in which they are giving you 5 tips on a daily basis. Don't go for that. Sometimes they work, but most of the time when I've seen people losing their shirt, don't go for it. And the fourth point, most of the traders lose money, so don't go for short-term investments. Kind of related with the first point, but again, I want to emphasize, don't think short-term in stock market. I think next point we have covered in one of the videos. Time in the market is much more important than timing the market. Right now, everybody is saying that markets are all-time high, no fresh positions advised. But my suggestion is, don't time the market that no, this stock or the market is at this level, so I should invest, and market is this level, so I shouldn't invest. Don't go for that. Just think that if an investment is available at your price, go for it and be in the market. Again, related to the first point, think in terms of decades. not in years, definitely not in quarters, months, or weeks, etc. And be prepared for drawdowns or your portfolio value going down. As I said, Warren Buffett has already told, in case you can't see your portfolio going down by 40% or 50%, don't be in the stock market. So it's not that nobody has lost money. No. As I explained in one of the previous videos, I think Peter Lynch said that 10% or 25% markets going down does happen. It will keep on happening, and you can't avoid if you want to make money in the market. So be prepared for it. And then the last one, the dumb money accepts its limitations, it ceases to be dumb. What it means is, when you know that you're competing against whole army of analysts, fund managers, and the data crunchers, uh, and you still think you can outdo them, it's I think a wishful thinking. Except that you can't do it, better go for some mutual fund or PMS in case you have limited time or limited skill. Don't fight against these guys because they get paid for doing the job. If they don't do it, they'll be fired. So that's my suggestion. We have come to the end of this video. So as I always say, in case you want to talk to me on WhatsApp, my number is 80889238849. If you want to call me and discuss, my number is 966 352 0068. Happy investing. Thank you.